First-time buyers are keeping the property ship afloat for now, but what are the consequences? Welcome to the Property Imperative Weekly to the 9th of December 2017. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. In our weekly digest of property and finance news, we start this week with the latest housing lending finance data from the ABS. The monthly flows show that owner-occupied lending fell 23 million compared with the previous month, down 0.15%, whilst investment lending flows fell 0.5%, down 60 million in trend terms. Refinance loans slipped 0.13%, down $7.5 million. The proportion of loans excluding refinance loans for investment purposes slipped from a recent high of 53.4% in January 2015 down to 44.6%, but that means that investment property lending is far from dead. While overall lending was pretty flat, first-time buyers lifted in response to the increased incentives in some states by 4.5% in original terms to over 10,000 new loans nationally. At a state level, first-time buyers accounted for 19% of the share in Victoria, 13.7% in New South Wales, both states where a more favourable stamp duty regime and enhanced grants were introduced during the year. But other states showed a higher first-time buyer share, with the Northern Territories at 24.8%, Western Australia at 24.6%, ACT at 20.1%, Queensland at 19.7%. South Australia stood at 13% and Tasmania at 13.3%. There was an upward shift in the relative number of first-time buyers compared with other buyers, 17.6% compared with 17.4% last month. But still small beer compared with the record of 31.4% in 2009. Now these are original numbers, so they move around each month. The number of first-time buyer property investors slipped a little using our household survey data, down 0.8% this past month. But together with the owner-occupied lift, total first-time buyer participation has helped support the market this month. The APRA quarterly data to September 2017 shows that bank profitability rose 29.5% on 2016 and the return on equity was 12.3% compared with 9.9% last year. Loans grew 4.1% thanks to mortgage growth. Provisions were down, although past due items were 14.3 billion as at September 2017. There was an increase of 1.5 billion, 11.8%, on the 30th of September 2016. The major banks remained highly leveraged. The property statistics showed that third-party origination rose, with origination to foreign banks sitting at 70% of new loans, mutuals around 20%, and other banks around 50%. Investment loan volumes have fallen, though major banks still have the largest relative share at around 30%. Mutuals are sitting around 10%, and interest-only loans have fallen from around 40% in total value to 35%, but this represents a fall from around 30% of the loan count to 27%. This reflects the higher average loan values for interest-only borrowers. The average loan balance for interest-only loans currently stands at $347,000 against the average balance of $264,000. It's no surprise, of course, as these loans do not contain any capital repayments, and hence the inherent risks involved, especially in a potentially falling market. But there has been a spike in loans being approved outside serviceability, with major banks reporting 5% or so in September. This may well reflect a tightening of their standard serviceability criteria and the wish to continue to grow their loan books. We discussed this on Perth 6PR radio. So overall, we see the impact of regulatory intervention. The net impact is to slow lending momentum. And as lenders tighten their lending standards, new borrowers will find their ability to access larger loans diminished. But the loose standards that we've had for several years will take up to a decade to work through the system. And with low income growth and high living costs, as well as the risk of an interest rate rise later, the risks in the system remain. On the economic front, GDP data from the ABS national accounts grew 0.6%. This was below the 0.7% expected in the quarter. This gives an annual read of 2.3% in trend terms, well short of the hoped for 3+%. Season-adjusted growth was 2.8%. Business investment apart, this is a weak and concerning result. The terms of trade fell. GDP per capita and net disposable income per capita both fell. And these highlight the basic problem the economy faces. The dollar fell in the news. Household savings also fell. So no surprise then that according to the ABS, retail turnover remained stagnant in October. The trend estimate for Australian retail turnover fell 0.1% in October, and that followed a relatively unchanged estimate of 0% in September. Compared to October 2016, the trend estimate rose 1.8%. So no surprise the RBA held the cash rate once again for the 16th month in a row. The latest BIS data on debt servicing ratios shows Australia is the second highest after the Netherlands. We are above Norway and Denmark, and the trajectory continues higher. Further evidence that current regulatory settings in Australia are not correct. As the BIS said, such high debt is a significant structural risk to future prosperity. They published a special feature on household debt in their December 2017 quarterly review. They call out the high risks from high mortgage lending, high debt servicing ratios, and the risks to financial stability and economic growth. All themes that we've already explored at length on the DFA blog, but it is a well-argued summary. Also note that Australia figures as a high-risk case study. They say central banks are increasingly concerned that high household debt may pose a threat to macroeconomic and financial stability. And they highlighted some of the mechanisms through which household debt may threaten both. Australia is put in the high and rising category. The debt ratio now exceeds 120% in both Australia and Switzerland. Mortgages make up the lion's share of the debt here. In Australia, mortgage debt has risen from 86% of household debt in 2007 to 92% in 2017. Basel III was finally agreed this week by the banker's banker, the Bank for International Settlements, or BIS, which is many months later than had been expected, and they have been somewhat watered down. Banks will have to 2022 to adopt the new, more complex framework, although APRA said that in Australia they would be releasing a paper in the new year, and banks here should still be planning to become unquestionably strong by the 1st of January 2020. We note that banks using standard capital weights will need to add different risk weights for loans depending on their loan to value. Advanced banks will have some floors raised, and investor category mortgages, now redefined as loans secured against income generating property, will need higher weights. Net-net, there will be two effects. Overall capital will probably lift a little, and the gap between banks on the standard and internal methods probably narrowed. Those caught transitioning from standard to advanced will need to think very carefully about the impact. This, if anything, will put some additional upward pressure on mortgage rates. The Treasury issued a report, Analysis of Wages Growth, which paints a gloomy picture. Wage growth, they say, is low across all regions and sectors of the economy. Subdued wage growth has been experienced by the majority of employees, regardless of income or occupation, and this mirrors similar developments in other developed Western countries. Whilst the underlying causes are far from clear, it looks like a set of structural issues are driving this outcome, which means we probably cannot expect to return to more normal conditions anytime soon. This despite Treasury forecasts of higher wages growth later and upward projections in line with many other countries. We think this has profound implications for economic growth, tax take, household finances, and even mortgage underwriting standards, which all need to be adjusted to this low income growth world. Mortgage underwriting standards are very much in focus and rightly given flat income growth. There was a good piece on this from Sam Richardson at Mortgage Professional Australia, which featured DFA. He said that over 4 days in late September, 2 major banks added extra checks to an already extensive application process. ANZ introduced a customer interview guide which required brokers to ask questions about everything from a customer's Netflix subscription to whether they were planning to start a family. 3 days later, CBA introduced a simulator that would show interest-only borrowers how their repayments would change and affect their lifestyle. Now, getting good information from customers is hard work, not least because, as we point out, only half of households have formal budgeting. So, when completing the mortgage application, households may be stating their financial position to the best of their ability, or they may be elaborating to help get the loan. It's really hard to know. Certainly, banks are looking for more evidence now, which is a good thing. But this may make the loan underwriting process longer and harder. More data this week on household debt, showing Australians have become more cautious of interest-only loans, with online panel research revealing that 46% of Australians are, quote, adamant decliners of interest-only home loans, according to research from the Gateway Credit Union. In addition, a further quarter of respondents are, quote, resistant approvers, acknowledging the benefits of interest-only loans, yet choosing not to utilise them. Of the generations, baby boomers were the most likely to be adamant decliners and therefore less likely to use interest-only loans, whilst Gen Y was the most likely to be enthusiastic users. Banks continue to offer attractive rates for new home loans, seeking to pull borrowers from competitors. Westpac, for example, announced a series of mortgage rate cuts to attract new borrowers as it seeks to continue to grow its portfolio and leveraging lower funding costs and the war chest it created earlier in the year from back book repricing following APRA's tightening of underwriting standards and restrictions on interest-only loans. Rates for both new fixed loans and variable rate loans were reduced. For example, the bank increased the 2-year offer discount on its Flexi First Option home for principal and interest repayments from 0.84% to 1%, putting the current 2-year introductory rate at 3.59%. The RBA released their latest bulletin, and it contains an interesting section on housing accessibility for first-time buyers. They suggest that in many centres, new buyers are indeed able to access the market thanks to current low interest rates, but the barriers are significantly higher in Melbourne, Sydney and Perth. They also highlight that first-time buyers, generally being the most financially constrained buyers, are not always able to increase their loan size in response to lower interest rates because of the lender's policies. Indeed, the average first home buyer loan size has little changed over recent years, whilst the gap between repeat buyers and first-time buyers' average loan sizes has widened. They also showed that in aggregate, Rents have grown broadly in line with household incomes, although rent-to-income ratios suggest housing costs for lower income households have increased over the past decade. Housing affordability has improved somewhat across all states and territories, allowing for a large increase in the number of loans for first-time homebuyers, according to the September quarter edition of the Adelaide Bank REIA Housing Affordability Report. The report showed the proportion of median family income required to meet average loan repayments decreased by 1.2% points over the quarter to 30.3%. The result was a decrease of 0.6 percentage points compared with the same quarter in 2016. However, housing affordability is still a major issue in Sydney and Melbourne, they said. In addition, over the quarter, the proportion of median family income required to meet rent repayments increased by 0.3% to 24.3%. Our own financial confidence index for November fell to 96.1, which is below the 100 neutral metric and down from 96.9 in October. This is the sixth month in succession that the index has been below the neutral point. Owner-occupied households are the most positive, scoring a 102, whilst those with investment property are at 94.3 as they react to higher mortgage repayments, thanks to rate rises and switching from interest-only mortgages, whilst rental yields fall and capital growth is stalling, especially in Sydney. Households who are not holding property, our property inactive segment, will be renting or living with friends or family, and they scored 81.2. So those with property are still more positive overall. Looking at the FCI scorecard, job security is on the improve, reflecting rising employment participation and the lower unemployment rate. Around 20% of households feel less secure, especially those with multiple part-time jobs. Savings are being depleted to fill the gap between income and expenditure. As a result, nearly 40% of households are less comfortable with the amount they're saving. And this is reinforced by the lower returns on deposit accounts as banks seek to protect margins. More households are uncomfortable with the amount of debt they hold, with 40% of households concerned. The pressure of higher interest rates on loans, tighter lending conditions, and low income growth all adds to the discomfort. And more households reported that their real incomes had fallen in the past year, with 50% seeing a fall, whilst 40% see no change. Only those on very high incomes reported real income growth. Finally, we also released the November mortgage stress and default analysis update. And you can watch our entire video counting down the most stressed postcodes in the country. But in summary, across Australia, more than 913,000 households are estimated now to be in mortgage stress, compared with last month 910,000. And more than 21,000 of those are in severe stress, the same as last month. Stress is sitting on a high plateau. This equates to 29.4% of households. We see continued default pressure building in Western Australia, as well as among more affluent households nationally, and typically beyond the traditional mortgage belts across the country. Stress did ease a little in Queensland, thanks to better employment prospects there. We estimate that more than 52,000 households risk 30-day default in the next 12 months, which is similar to last month. We expect bank portfolio losses to be around 2.8 basis points, though losses in Western Australia could be rising to 4.9 basis points. So the housing market is being supported by first-time buyers seeking to gain a foothold in the market. But despite record low interest rates and special offer attractor rates, many will be committing a large share of their income to repay the mortgage, at a time when income growth looks like it will remain static. Cost of living are rising and mortgage rates will rise at some point. All the recent data suggests that underwriting standards are still pretty loose, and household debt overall is still climbing. This still looks like a high-risk recipe, and we think households should do their own financial assessments if they are considering buying at the moment. For home prices are likely to slide, and the affordability equation may be worse than expected. Just because a lender is willing to offer a large mortgage, don't take this as a confirmation of your ability to repay. The reality is just so much more complex than that. Getting mortgage underwriting standards calibrated right has perhaps never been more important than in the current environment. And that's the Property Imperative Weekly to the 9th of December 2017. If you found this useful, do leave a comment, sign up to receive future research, and check back again next week for the latest update. And many thanks for taking the time to watch.